Hello and welcome back to another week of your Mortgage Market Moves Weekly, where we are detailing everything that's going on in the macroeconomy to help you make better home buying decisions. This week's 30-year fix is not out yet, but just as a reminder, last week's 30-year fix was sitting at a 6.3, which was up from 6.23. I'm expecting that the 30-year fix is probably going to be a little bit higher as tensions are still there in the Middle East and oil has not climbed down. We did get some news, I believe it was this morning and over the weekend, about the Middle East conflict, and we also have some data that will be coming out this week. So let's hop right on into that. So we are on the U.S. 10-year, and as you can see, I mean the 10-year is just climbing. Not great. So yeah, like I said, I'm anticipating that 30-year fixed is not going to be looking great for this upcoming week. You can see just bond market is not holding on too strong. It looks like, just a sell-off as inflation continues to look like it's going to be an issue. And as oil prices look like they are not coming down. We could take a look at oil. And I mean, just monster move upwards, right? From, let's see, April 17th. That is probably when, coming down here, I want to say maybe that's when one of the ceasefires was announced, but, oil has just been climbing lately, and that is bad news for inflation. So, with this oil supply shock, I just don't think that investors are confident in buying into the bond market. And if they don't buy into the bond market, yields will have to continue rising in order to be attractive to investors. So with rising yields, we can expect rising mortgage rates. And, unless we see some kind of resolution to this Middle East conflict and see it soon, oil is just going to continue to be an issue. And even when we do see a resolution, we have to see, just what's going to happen. Is it going to go back to normal? Like, is this the new normal down, like maybe around like sub 100, but definitely not sub 70? We have to see. But this is just definitely an issue for inflation. And, the options are really to, I don't know, I guess like, see if this is more of a transitory inflationary pressure, or if this is going to be long lasting and it's going to have a harder shock on inflation. But we will see. So there was news, I want to say, so Trump said that there was going to be, I believe the U.S. were going to help ships that were stranded, kind of like in the Strait of Hormuz, going to help escort them out. But then there was Iran claimed that they fired missiles at the U.S., and then the U.S. said, no, that didn't happen. So, just a lot of back and forth and not really knowing where we are. This whole conflict, it just kind of feels we don't really know where we are. So until there's more clarity, until we see resolution, this is going to be a problem. So keeping an eye on that, and all we can do is keep an eye on it. Now, if we go over to the economic calendar, I did see this. There's a loan officer survey, and when you dig into it, really just April. So this is a opinion survey on bank lending practices. I don't know if that's that. Important for us to look at. Let's see. There were two sets of questions. First was about banks' changes in lending policies, and then demands for commercial real estate loans over the past year. And the second set was lending practices and demands for non-depository financial institution loans over the. All right. For loans to household, banks reported basically unchanged lending standards and unchanged or weaker demand for most categories of residential real estate loans on balance. I mean, this is the important part for us. Let's see, unchanged or weaker demand. So, just kind of reaffirming what we already knew. Demand is not as strong, and I wonder why. It's these interest rates, right? So let's see. I will say anecdotally though, it does seem like, I don't know. It's almost kind of hard to find a property for some borrowers out there. They are getting outbid. So I don't know. Maybe something positive on the horizon, anecdotally at least. We have to wait and see what the data actually says about that. So let's see. So Jolt's job opening. We have new home sales, May 5th. Let's see. So this is February data. I thought that there was... Oh, and then this is going to be the April data. So we get both. Let's see. Non-farm employment change. So labor stuff. So it looks like a good bit of labor information is going to be this week. Consumer credit. That's interesting to see. Labor data. And then consumer sentiment and inflation expectations. This definitely does impact things like in the financial markets. So, it's important to look at those and see what people are thinking. And then it's just different Fed members speaking. And that can sometimes be pretty important and give us a little clue. But really, it's the big FOMC meetings that we really pay attention to. I'm not going to be listening to any of that. Let's see, moving on where I looked at that. So, let's see, when we look at the probabilities of a Fed rate cut, look at this. In 27, it looks like there's even financial markets are pricing in a rate hike, second quarter of 27. So yikes. That's the probabilities aren't vastly greater for a hike than they are for a pause, but still, that 38% over 37.3. So financial markets are already going to price that in and make that expectation as of now that, rate hikes are on the table. If inflation can't settle down, if these oil prices don't come down and it's inflationary, then the Fed are in a tough spot and it's going to be potentially a hike. Then right back to a pause, and then pricing in maybe one cut in September of 27, and then maybe if we get that cut, going back to a pause. So it's kind of like this zigzag right now of really it's like the pause is the default, and then just pricing in potentially different either hikes or cuts, and really the only thing that we can do right now to keep an eye on this is just watch really inflation in the labor market. I feel like labor market, that's part of the dual mandate, but really the inflation is what's important to us in the real estate industry, but also, that's really where things just are not looking hunky-dory. It doesn't, some data in labor does not look great, don't get me wrong, but, it's really this inflation data that's just like, it's not working out too hot right now. Like I said, we do not have anything past April 30th, so 6.3. I think it's going to be a little bit higher, though, especially with that 10-year yield rising. Again, this is only applications. That's how they get this data. So, it's totally possible that, there's different things like discount points or, just, I don't know, like different scenarios that impact this. So we don't want to take this as gospel, but it is interesting data to look at. That's really all I got for you this week. So if anyone has any comments, questions, concerns, reach out to us at www.mortgagesbylinda or give us a call at 877-TEAM-MBL. All right, have a great week, everyone. Bye.